Hello, everyone, and welcome to today's webinar, Additional Coronavirus Response and Relief, Analysis and Action. I'm Yonina F. Scheinweather, CPA, the Consulting Director of Compliance at Viventium. And today we're going to be taking a very action-oriented look at the brand new coronavirus relief, been given many different names, PPP2, COVID relief, second draw loans, a lot of different names to this law. We're going to take a look at exactly what the law is called and how it works and how it's structured. But more importantly, we're going to analyze it. And we're going to talk about preliminary action steps that you can take to maximize benefit to your company, some more talked about provisions, some littler known provisions, and hopefully a lot of very practical information. Just a couple of housekeeping points before we get started. Today's webinar is being recorded. The slides and the recording will be made available to you afterwards, so you can feel free to share it with your colleagues, coworkers, you review certain points yourself. I also want to encourage everyone to use the question box on your GoToMeeting, GoToWebinar toolbar. You'll see there. And if you do have any questions throughout the webinar, please enter them. Don't wait till the end. I do try to keep my eye on those questions. Those of you who have done webinars with me in the past know that I always say that if there's something that's not clear to you or needs further elucidation, further clarification, it's probably on other people's minds as well. And you'll be doing everyone a favor, not just yourself, by asking the question. And if time permitting, and we want to try, we have a lot of information to fit in to this hour, but time permitting, we'll try to allow some time for the additional questions and answers at the end, even if it's things we don't get to during the presentation itself. So please make this as interactive as possible and do take advantage of your question toolbar. Now, before I even launch into the analysis and the action steps, I think it's important for everyone to know that this is very emerging. The law itself that we're going to be talking about is a body of law almost 5,600 pages long. And the guidance that's going to result from that law is still not fully out. IRS issued one revenue ruling, but has a lot more to come. SBA had been tasked with issuing guidance by January 6th, which was 10 days after the passage of the law. That's the Small Business Administration part of it. They actually issued guidance late Wednesday night, January 7th, and a lot of it is fresh and raw and not yet interpreted. So they're probably things that we're going to be talking about today that are not yet clear. I'm going to be emphasizing what's still a question, and over the upcoming days and weeks, more information and a deeper picture will emerge. So again, just a little disclaimer here that everything is very preliminary, information is still emerging, and of course, Viventium is not providing any actual legal, accounting, or tax advice. That's to be discussed with your relevant professionals before making any financial decisions. That said, let's take a look at this law. If you notice that nobody really knows what to call it, it doesn't have like a nice name like FFCRA or Fcra. It was the Family's First Coronavirus Response Act, or the CARES Act, which was really the largest relief package in the history of the country. There's no good one name for this law. If you'll notice, it's written up in many different places, and that's because of the way it was put together. Basically, the name of the law is the Consolidated Appropriations Act 2021, but that's an umbrella name for many, many different acts, many, many different laws that have been bound together in this very, very large federal spending budget. The Consolidated Appropriations Act is a 2.3 trillion spending package, basically the federal budget, but it contains divisions, and each division contains many titles or subtitles or chapters or sections and subsections, depending on what the division is. There are altogether 32 divisions in this law. They're labeled Division A, B, C, till we get to Division Z, and then starts AA, BB, C, until FF, basically 32 divisions. There are two divisions of the Consolidated Appropriations Act that are of concern to us in the payroll world. And those two divisions are Division N and Division EE. N has a name. It's called the Additional Coronavirus Response and Relief Act. So we could be talking about additional coronavirus response and relief, but that would not include, for example, the employee retention credit, because that's not in Division N. What is in Division N is the COVID-related Tax Relief Act of 2020, and that is about FCRA and extending the FCRA payroll tax credits. We'll get into that. There's another act in Division N, among others, but another one that's of relevance to payroll, and that's called the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. In short, that's the PPP2 Act. And that's where all the extension and expansion of the PPP program comes in, which of course is important news and a lot of action steps there. Some of the most important action steps, though, as we'll see, are just wait. That's the smartest action you can take at this point, but we'll get into that. Then there's Division EE. And with all the, the hype and the excitement about PPE, it's actually Division EE that may bring a greater financial advantage, a greater relief offering to your company, because Division EE is called and contains the Taxpayer Certainty and Disaster Tax Relief Act of 2020. And what that does is it extends and expands a credit that many of you on the call today may not have taken, called the Employee Retention Credit. And the reason that you didn't take that is because it could not be taken, the Employee Retention Credit could not be taken together with a PPP loan. And that is changing. And that's probably the biggest news about this entire COVID relief package. So we're going to be spending a significant amount of time discussing not just PPP in Division E, but the Employee Retention Credit in, PPP in Division N, but the Employee Retention Credit in Division EE as well. I see some questions been coming in about PPP. We'll try to take a look at them when we get up to PPP. Just to repeat for those of you who are asking, the handouts, meaning the slide deck, will be available after the session, as will the recording. And again, just reminding those of you who may have joined a little bit later, please feel free to use your question bar to ask questions as we go along. So let's take a look at some of the main payroll provisions. Now you have to remember the Consolidated Appropriations Act is literally humongous. It contains basically nearly every type of financial appropriation, that could manage to make its way into the federal budget, including a new Smithsonian museum, and I mean, you just name it, it's in there. But what we want to really zero in on, laser beam, is the payroll provisions, the main payroll provisions. So the first one over on the left-hand side, which is really the one that stands out there in the boldest box over there, the Employee Retention Credit has been extended into 2021, and it's also been expanded. Very, very important and significant. Another important credit that's been extended is the FCRA credit. That's credit that employers get for paying leave to their employees who are not able to come to work due to qualified pandemic-related reasons. That's going to continue. It was set to expire on December 31st. That's actually going to continue for the entire first quarter of 2021. Now, that doesn't mean that you have to pay leave to your employees as you had to in 2020. If you recall, under the FCRA, under the Families First Coronavirus Relief, you were expected to pay employees' wages up to a certain percentage, up to a certain limit, if they had to take time off either for self-care due to the pandemic or to care for another, was it a lower limit? Or if they had to take off to care for a child whose place of school or daycare was closed due to COVID-19 related reasons. That was all called FCRA leave. And if you paid FCRA leave, the Department of the Treasury said, well, we will pick up the tab. It's not going to have to come out of your pocket, because whatever you pay in FCRA leave, you can reduce your payroll tax deposits by. And that, of course, led to situations of credits and advance credits. That entire provision of crediting has been extended for the first quarter. But the requirement to provide leave, which was administered by the U.S. Department of Labor, that has not been extended. You no longer have any requirement under Department of Labor to provide paid time leave off, even if it's due to COVID-related reasons, even if an employee is taking time off to care for a child whose daycare is closed, doesn't matter. You're not obligated to pay that leave. If you choose to, though, you can continue taking the credit. Now, one of the greatest, biggest open questions that Congress's wording left was, what about the limits? You all know, we can invite you to visit viventium.com if you're not familiar with what I'm talking about, but if you visit our webinar section on viventium.com, you'll find comprehensive treatment of FCRA and the FCRA limits. But for those of you who are familiar with the limits, if someone was taking off for self-care, they could get up to $5,110. If they were taking off to care for another who was quarantined or who was not able to work due to pandemic qualified reasons, they were able to get up to $2,000. And if they were taking off to care for a child, and what was called the extended family leave, they were eligible for up to $10,000. And one of the big questions that Congress did not address was, well, what about the limits in 2021? Do they reset? Meaning, if I've had an employee who collected from me $10,000 in paid time off because their child's school was closed and they had to stay home and they couldn't work, they already got their $10,000. Do we say that since this credit is extended into a new tax year, they're entitled to another $10,000 or another $5,110 or another $2,000, depending on what leave they're claiming? Do the limits reset for tax purposes? And the IRS has not issued any written guidance on that yet. However, in their payroll industry phone call of today, as a matter of fact, the IRS representatives orally represented that, no, the limits do not reset. They are going to be looked at as lifetime limits. You're probably some of the first people to be hearing this. I don't believe it's even been reported on by Reuters yet, but it will be reported by the news services. But Viventium was on that call, and the guidance issued by the IRS orally was that the limits do not reset. That means if you had an employee who collected $1,000 in FCRA leave because they needed to care for perhaps a mother who was quarantined due to the pandemic, and they took off time and they were paid $1,000. If they are taking off in first quarter of 2021 to care for that same individual, and you choose, you're not obligated to, but you choose to pay them paid time off for that, then you can only pay them for that other care another $1,000. You can pay them more, but you'll only get credit for a $1,000. In other words, till you bring the limit up to the $2,000. It's not that it resets and they can get a full $2,000 credit. You can get a full $2,000 credit to them. No, it's a lifetime limit on the credit. Now, this is really a first. This is really a first in that taxes, especially any law administered by the IRS, has always been a calendar year. I mean, we've never had a case where limits, it's not PTO, we're not talking about rolling over, we're talking about tax credits are being carried across years. It's very, very unusual, very big surprise, but this is the position that the IRS has staked out in their payroll industry phone call today. We are hopeful that they will soon actually state that in writing, which would certainly be a whole lot more authoritative, and give guidance to the payroll and employment community as to how to handle these credits. And I want to pause and address a couple of questions that have been asked about the new FCRA provisions. One question was, did I hear correctly that we are no longer required to pay the FCRA leave pay? And the answer is yes, you did hear correctly. As a matter of fact, Department of Labor, U.S. Department of Labor just issued guidance. And again, all this guidance is rolling. It's continually coming out now since the law was signed on December 27th. Yes, U.S. Department of Labor clarified in its guidance that there is no longer an obligation for employers to pay leave to their employees on the federal level. Of course, there may be some state laws, but on a federal level, it's no longer required, and there is no FCRA mandated leave. Nonetheless, the IRS has clarified that if you do go ahead and pay that leave, then up to the dollar limits that are allowed, you will be entitled to the credit, but carrying forward the limits that you paid to those same employees if they worked for you during 2020. Now, a couple people seem to be asking a similar question. Weren't the FCRA limits limited to hours? In other words, if you were taking off time for self-care or for other care, it was 2 weeks, or it was based on, of course, it was based on 80 hours if you had 2 weeks there. And if you were taking off FMLA, the extended family leave, you were entitled to 10 weeks. Yes, it was based on hours and weeks. However, even within those hours or weeks, the amount that you were allowed to get credit for, the amount that you required, was only up to the limits, the dollar limits. So in other words, you were required to pay up to 80 hours of sick time, but not more than $5,110 to cover those 80 hours. Okay, so therefore, you would still need to be looking at what your previous payments during 2020 were in order to know how much is still available for you to get credit for if you choose to pay it to your employees in 2021. Now, this is going to be an interesting kind of, just from a software point of view, from a payroll application point of view, it's really going to be an interesting type of situation where limits are going to have to carry over from one year to the next. So we are looking forward to seeing that in writing from the IRS. Let's continue to another one of the payroll provisions of the Consolidated Appropriations Act. And that is something that not too many employees or employers went for, but President Trump had signed a presidential executive memorandum stating that employees could defer their payroll tax, meaning their Social Security tax, for the last 4 months, September through December of 2020. And the plan was, the original IRS plan of attack was that it was going to be withheld ratably, meaning proportionately, throughout the first 4 months of 2021, meaning employees would see double Social Security withholding during those first 4 months. The new law the Congress passed extended the repayment period through the end of December 2021, which means if you had an employee that you, and most employers in America did not opt for it, but the federal government did for all federal government employees and members of the armed forces, they all had their employee Social Security withholding suspended, deferred during those last 4 months. The amounts that were deferred are now going to be spread over all 12 months of 2021, unless an employer chooses to expedite it and get it over with sooner. And again, the IRS is going to be working on developing provisions that it shouldn't be seen as late tax. They are going to require W-2Cs, but not 941Xs. It's quite a bookkeeping and accounting hurdle. But the change is that the spread is going to be greater. The amount that was deferred over 4 months is going to be now withheld and spread over up to 12 months. What about employer Social Security deferrals? Now, I've seen, especially for the initial write-ups, webinars, presentations that have been done out there, I've seen a lot of confusion about the employer Social Security deferrals. And this is something that most employers did take advantage of, including, I'm sure, many people who are participating today. And that is that employers were able to suspend, to defer their depositing of their share of the Social Security tax through the end of 2021, I'm sorry, through the end of 2020. What's happening with that in 2021? So let's make it clear that is not being extended. Employer deferrals are over, unless a future session of Congress will pass some additional legislation, but there is no extension of the employer Social Security deferral. That is now in effect. All employers have to go back to depositing their Social Security taxes. However, the dates on which the deferred amounts, the 2020 deferred amounts are due, those dates have been updated just slightly. The IRS had said it's due December 30, half of it's due December 31st, 2021, half of it's due December 31st, 2022. Interestingly enough, the IRS just issued publication 509, which is its payroll tax calendars. And for some reason, they picked January 3rd. kind of interesting because even in 2023, January 3rd is not a Saturday or Sunday, but it's not even a Monday, not following a Saturday and Sunday, it's actually a Tuesday, I believe, but they picked January 3rd as the repayment date. 50% of your 2020 deferred employer Social Security is due by January 3rd, 2022. And 50% of it is due by January 3rd, 2023. So just a couple extra days there, but sometimes year end and with the busyness of year end, it's good to have that little bit of leeway. FSA rollovers. So flexible spending accounts are modified or made more flexible as part of the COVID relief. We're going to take a look at what those flexibilities are. And of course, the major news that everyone wants to talk about is the Paycheck Protection Program. It has been extended, it has been expanded. There's been another $284 billion of funding set aside for PPP loans, both first draw and second draw. And we're going to see what that means, first and second draw. I know that's what everybody wants to hear about. And even though everyone's excited about that, I think we need to first, before we do anything at all with PPP, digest and analyze. Late last night, late Wednesday night, January 6th, the SBA actually issued guidance. As I mentioned before, they were mandated to do it, and they got it in on January 6th. They were mandated, they got it out there. They issued about 125 pages of guidance. These are, again, interim final rules, not yet final rules, but they're interim final rules. The first one is regarding existing first draw loans, the PPP program as amended. And the second one, 42 pages, is about what's being called second draw loans. Now, I will actually be hosting with Viventium a webinar to discuss this guidance, which will flesh out some of the laws written by Congress, signed by the President, next Tuesday, 2 to 3 p.m. Eastern Time. That's January 12th. We'll be taking a closer look at this guidance and how it modifies and how it expands the PPP based on the law. What we're going to be discussing today is the law itself, what Congress included in the law, and not yet the perspective of SBA guidance, because that came out as we were going to press. So let's take a look at some of the key PPP provisions. First of all, Congress has mandated that there are additional categories of employers who can now qualify for PPP: hospitals, farmers, ranches, certain media, newspaper that may be part of an affiliated group and were disqualified before, some 501c6 organizations, certain types of medical organizations. Other employers that never qualified before will now qualify. They've also said that certain costs that have never qualified before, non-payroll costs, can be included in the amount to be forgiven. So we all know, it was like a tenet of PPP, that there were 3 kinds of non-payroll costs, right? There was mortgage interest, could be counted, rental, lease amounts could be counted, and utility costs. That included telephone, internet. Those costs were countable, and you could request a loan based on the size of those amounts and get forgiveness if you used it for not more than 40% of your forgiven amount could be these non-payroll costs, but they were there. The new law, the new relief, has actually expanded the types of costs. It includes supplier costs, operational costs, investments in PPE for your employees, or facility modifications. We'll take a little bit of a closer look at that soon. In addition, there are new amounts that are being classified as payroll costs. Any type of group benefit payments, vision, dental, disability insurance, group life term insurance, any type of group benefit premiums paid by employers on behalf of their employees are now actually going to be counted as payroll costs. Now, what's the significance of that? Why do we care if it's a payroll cost or a non-payroll cost? So to remind you that your forgiveness amount had to consist at least 60% of payroll costs and only 40% of non-payroll costs. So now that more items are being included in payroll costs, that will boost a lot of people's ability to get full forgiveness and perhaps even to increase the amount of their loan, which is something we'll take a look at. If you received an economic injury disaster advance, in other words, you went for an economic injury disaster loan and you got an advance, the original guidance from SBA was those EIDL advances had to be deducted from any amount that you were forgiven for. Otherwise, they said it would be double dipping. You received it, you know, we're going to deduct that. And basically, the Congress made it very clear that their intention was, no, we want people to be able to have their EIDL advances. And we also want them to be able to get full forgiveness, because otherwise what we're saying is the EIDL is basically becoming not taxable and not forgivable. So they want it to be clear that the EIDL advance is not going to be deducted from forgiveness. They've also expanded, and when I say they, I mean Congress. We're going to see what SBA is going to do with this. We have indeed seen in the past where Congress has said one thing and SBA seems to be taking a different interpretation of it altogether. We've seen that the first time around in the CARES Act. So until we, you know, comb through carefully everything that SBA is issuing in their 125 pages of their interim final rules, we're not going to know how this is going to translate into practice. But at least according to what Congress is saying, and I'm sure it will filter down to the SBA in one form or another, simplified forgiveness has been expanded to loans under $150,000. Up until now, it was only for $50,000 and less, and now it's being expanded, and we're going to take a look at that in a little more detail as well. And then a very big provision, and this was something that the employer community was lobbying on, one of the strongest efforts, and that was that if you use expenses for forgiveness, whether it's payroll expenses or non-payroll expenses, the Department of the Treasury, the IRS, had taken the position that those expenses cannot be tax deductions on your business tax return. And the IRS's reasoning was, if you're getting forgiven for them, meaning the government is paying for them, why should you also get to deduct them on your tax return? Now, the business community, the employer community said, no, that was not the intent of Congress. Congress didn't mean that we should lose out on deductions. They just wanted to give us an extra boost by giving us this forgivable loan. The IRS dug its heels in and they said, no, absolutely not. So Congress made its intention very clear. And in the Appropriations Act, in the coronavirus response, they basically said, yep, you can deduct it. Even if you get forgiven for your payroll expenses or for your other qualified expenses, whether it's a first draw loan, a second draw loan, you can get forgiven, and you can still take those payroll expenses, those utilities, you can still take it as a deduction on your tax return. So of course, tax accountants take note. An action item here. Some of these provisions do not apply if you've been forgiven already. I should say none of these provisions apply if you've been forgiven already. What if you've applied for forgiveness but haven't gotten it yet? Well, the law's silent about that. We don't know. So it probably is a wise idea to consider waiting until this newly released SBA guidance gets analyzed before you apply for forgiveness. If you're in the middle, if that application is just about to go into the mail, the ink is still wet on it, hold off. Let's first see exactly what the SBA is going to be saying. And, you know, it's only a matter of a little bit more time, a week or so. Let's get this analyzed. Action item right now is no action. Pays to hold off and not yet apply for forgiveness. Let's continue on. PPP2, as it's being called. Another round of PPP loans is going to be opened up for certain companies, not publicly traded companies. You have to have less than 300 employees or less. The original loans were 500 and less. This is now targeting specifically smaller employers, 300 and less. You have to be able to show a decrease of 25% of revenue for any one quarter of 2020 compared to 2019. So that means if you had a big decrease in first quarter when the pandemic first broke out, and then you recuperated and your business got back on its feet and you didn't have any further decreases, it's okay. You can still use that first quarter decrease as a justification if you can prove necessity that you still need the funds, but that would be enough of a decrease to qualify you potentially for a second draw loan, as Congress is calling it. As a matter of fact, $35 billion of the PPP funding is being set aside for those companies who did not, those employers who did not get a first loan. So they're really trying to target smaller employers who, for one reason or another, didn't make it into the first shift. They're getting a chance at a second draw, but it doesn't mean that if you got a first loan, you can't take a second draw. Let's be clear about that. Even if you've gotten a first loan and you meet the other requirements listed, the 300 and the 25% rule, you can still go for a second draw loan, except you first have to use up your funds from your first loan before you get your second disbursement. And keep in mind that second draw loans have a limit on them. There's still 2.5 times your average monthly payroll during your look back period, but they're limited to only $2 million. So now, once again, you may want to consider waiting before applying to forgiveness. Anything to do with PPP, right now it's more the waiting game. But if you do believe that you will qualify for a second draw loan, you want to be following the Ventium space closely. And as soon as the loan application is made available and opens up, it probably pays to be one of the first to get in there, especially if you didn't take a first-time loan. Now, also yesterday, January 6th, the IRS issued guidance, and they basically backtracked, they reversed their position based on what we just said. I've given you a copy here of the beginning of the revenue ruling. It's the second one of the year. And they clarified that they are implementing Congress's enactment and that PPP expenses are now tax deductible. They begin with this ruling obsoletes our earlier notice, which is where they stated that if you took those expenses, you couldn't, if you claimed them for forgiveness, you couldn't also take them on your tax return as a deduction. They are backing out of that. They are obsoleting that earlier notice. And for those of you who want to check that out a little bit more detail, you have the revenue ruling right here. Now, before everybody gets all excited about their second draw loans, which I have to say is a matter of excitement, I think it's important to realize that the extension and the expansion of the employee retention credit may be just as big, if not bigger. We're looking at probably millions of dollars of retroactive credits across the country, probably being applied for by the various payroll services across the country on behalf of employers. So what exactly is this all about? So first of all, just to refresh our memory, the employee retention credit means that if you have employees and you can't bring them into work and they can't telework because of pandemic-related reasons, and therefore you're experiencing either a total reduction, let's say you're a restaurant, let's say your business has been shut down, or you have some type of a partial reason that you can't bring these employees in, or they can't work as much as they would normally work, so they're on partial retention. And despite the fact that they're not working, or in some cases, even if they are still working, you're keeping them on payroll, but you keep them on payroll, you keep paying them, then the Treasury, mandated by Congress, was going to pick up a portion of that payroll. You were going to get a credit for up to 50% of what you paid to these employees on their first $10,000 of wages for the year for 2020, and that was set to expire on December 31st. That means for each employee that you kept on retention, that you kept on paying, even though they weren't working for whatever reason, or for a pandemic-related reason, you kept them on the payroll, you would be entitled to up to $5,000 for that employee in credits for amounts you paid, and those were credits against your payroll taxes. So it was a 50% credit of the first 10,000 wages for the year. First thing that Congress did was they extended the employee retention credit through June 30th of 2021, which means it will be in effect for the first and second quarter. They've also made it a little bit more liberal going forward into 2021. And they've said that back in 2020, in order to qualify, you had to show that you had a decline in gross receipts of 50%. Now you only have to show a decline of 20%. Also, going into 2021, the credit is not going to be 50% of the wages that you pay. It's going to be a whopping 70% of the wages that you pay. So if you're paying up to $10,000 of wages, you get 70% back. You get $7,000 back in payroll tax credits. Also, that $10,000 limit is now a per quarter limit, not an annual limit. So for the first quarter, you'll get up to $7,000 per employee on retention. And for the second quarter, another $7,000. That $10,000 limit resets now. It's a quarterly limit. Big, big expansion there. They've also changed something in a number of employee threshold. And we're going to talk about that in a minute. That's a little more complicated, but the threshold has gotten higher. They've been expanding who's going to be entitled to higher credits. And we're going to see how that works. It went up from 100 to 500. And you still are going to be able to file Form 7200 and get those credits in advance. You don't have to wait for your 941, meaning if you pay employees on retention and you want to offset it against your payroll tax credit, go right ahead and do it. But what if, against your payroll tax deposits, what if the credits that you have because you paid employees are greater than the amount of your payroll tax deposits? How do you get that money? Do you have to wait till the 941 at the end of the quarter? No. In 2020, we had what was called the Form 7200, the first IRS form that was only filed by fax. You could fax it in, and you would get that credit up front ahead of time. That 7200 process is going to continue, but the advance credits have been restricted. You're only going to be able to get an advance credit if you fall into the less than 500 employee category. And you're only going to be able to get advance credits for up to 70% of your 2019 average quarterly wage. Kind of an unusual restriction, but that's what there's. And now that doesn't mean you won't get the rest of your credits. You'll still get them on the 941 at the end of the first quarter and at the end of the second quarter. But the amounts that they're going to allow on the 7200, that faxed form where you got advance credits, that's going to have these restrictions. Now, the IRS just stated in their payroll industry call today that they are expecting to issue a revised Form 7200 later in January. So that is something that's coming down the pipe for us to keep our eye on. They also asked employers in today's call, they asked employers not to file the existing 7200s, not to try to get these credits right now. Don't fax them in right now. Hold off until the new form is going to be issued. I don't know what would happen if you would fax in. Would they honor it? Would they not honor it? But they are asking the employer community to just sit tight. You know, all these things are happening very last minute. The law signed on December 27th. It has such, far-reaching impact. So they're just asking everybody to sit tight, not to apply for their advance credits yet. Wait for the new issuance of the 7200 later this month. And now comes the big one, and it's in red over there. For the entire 2020, our mantra has been, if you take a PPP loan, you can't also take an employee retention credit. And we said, yes, it makes sense. That's fair, because you can't double dip. If you're taking a loan and you're getting it forgiven so that the government is paying your payroll, then how can you also expect to get a credit for wages that the government is paying for you? That would really be unfair double dipping. And so we kind of bit the bullet and we understood that PPP and ERC don't go together, they don't mix. Well, big surprise. In the new legislation, in the new federal spending budget, Section 206 tells us that the PPP and the ERC are now friends, and you can take both. That means that even if you took a Paycheck Protection Program loan, if you continue to pay employees who weren't working due to pandemic reasons and qualified and all that, you can take the employee retention credit. Well, you might say, oh, if only I had known that, I could have saved so much money. Well, guess what? It's retroactive. You can go back to any payroll after March 12th. In other words, payrolls from March 13th, check dates till the end of December 2020, and you can retroactively request employee retention credits. That is major. Now, of course, they're still going to say that any wages for which you claim the employee retention credit are not eligible for PPP payroll forgiveness costs. You can't, that would really be double dipping. They're not gonna, if you claim the employee retention credit on wages, you can't expect to include those and for those to be acceptable as payroll costs for forgiveness. However, if you have enough payroll that you were paying people that weren't on retention, then it might not make a difference. And everyone, of course, has to do their own analysis with their tax advisor. It may pay anyway to go back retroactively, get employee retention credits. And there's no limit on the number of employees you can get a credit for. It's whoever qualifies and meets the requirements, but you can go back. And if you have enough other payroll, then you won't even lose out on your forgiveness. Retroactive ERC is allowed. Will amendments be needed? That was like the first question that everyone was asking. Do we have to go back and amend second quarter, third quarter? What's going to be? So in Section 206, Congress charges the IRS with inventing a mechanism so that earlier quarters will not need to be amended. Any employee retention credits that are being claimed for earlier quarters are going to be treated as though those wages were paid in the fourth quarter of 2020. Now, what exactly that means, given the fact that fourth quarter of 2020 is over, what this mechanism will be, what the IRS is going to do, the IRS updated the community today that they're working on it. They're working hard on it. They plan to issue guidance. They plan to issue modified forms. We can only predict that probably in the first quarter 2021 941, we may have one or more lines there where employers can claim prior credits for employee retention credit in 2020. And if anybody has taken a look at that draft 941 that was issued even before Congress passed its law, there were so many lines there that just said reserved for future use. I don't know if anybody saw that. So now I'm sure the IRS will be able to take advantage of all those reserved for future use lines and issue a new draft 941 for first quarter of 2021, which will have to handle all of these retention credits. So important action item here, review your payroll records. Go back to your first check dates after March 12th and begin reclassifying employees who qualify for retention. You would be working with your payroll service on this. You'd be working with your tax professionals on this and figure out which employees you can now put on retention and get that credit, meaning $5,000 up to $5,000 for 2020. You can't use the 70% limit yet. All of those credits, all of those expansions only apply going forward into 2021. The retro 2020 credits follow the old rules, 50% up to $10,000 in wages. But wow, $5,000 per employee on retention can be a significant benefit, a significant relief to many, many employers throughout the country. What about what I was saying, the expansion of the threshold from 100 to 500? What does that mean? So if you had read the law carefully, under the old rules, under the CARES Act, which was passed in March, if you had 100 or less employees, actually average monthly FTEs in 2019, that was what they used to count your employees, your workforce, you were entitled to that $5,000 per employee credit, up to $5,000 for payroll you paid, whether or not the employee worked. Even if they were still coming into work, but you were a small enough employer, Treasury was going to help you out. That was passed by Congress in the CARES Act, and they would pay up to $5,000 of that payroll. They would give you credit for it. Once you crossed 100 employees, though, you only got credit if your employees didn't work. They weren't coming into work, and also they weren't able to telework. And that didn't matter if you had 300 or 400 or 500 or 1,000. Once you were over that 100 threshold, your credit was limited to only those employees who weren't working. Comes the new coronavirus response and relief rules. And it says, well, if you're 100 or less and your average monthly FTEs for 2019, yeah, you get a credit for employees who work and don't work. And as long as you're under 500, meaning that whole range from 100 to 499 FTEs, we will still give you a credit, and you can get this under the new rules, we will still give you a credit for employees even if they are working. We're going to help subsidize your payroll. And of course, if you're 500 and up, then you go back to the old rule. It's only for employees who don't work. We're not going to actually, if you're such a big company, we're not going to pay you for your payroll for people who are actually doing work for you. Which means this whole middle area from 100 to 499 employees, this is an expansion that employees, even if they're working, you'll still be able, and you keep them on retention, of course, they're working, you're paying them, you'll still be able to get that credit for their wages, the ERC, the Employee Retention Credit. But again, remember, the retro credits follow the old rules. This only is for those credits going into 2021. You can't go back and say, oh, well, I had 400 employees and I have employees who were working, can I get credit for them? No, the retro credits follow the old rules. This expansion is going forward into 2021. It's a threshold change for quarters 1 and 2 of 2021. What's going on with your flexible spending accounts? So usually health and dependent care FSA unused amounts are lost or canceled out at the end of the year. You cannot roll them over. But due to the straits that the pandemic is placing on population, Congress has decided that rollovers will be allowed both from 2020 into 2021 and 21 into 2022. And as a matter of fact, employees will be able to change their contribution amounts mid-year, which is usually not allowed throughout 2021. What's the action item here? Modify your PTO plans. Work with your payroll providers and partners to make sure that your PTO plans are compliant with this new requirement in the coronavirus response and relief. Now, the remaining time, we're going to turn our attention to PPP. There are 5 main changes and expansions, all good ones, all beneficial to PPP. Trick is knowing which loans, which expansions apply to. And it's not an easy trick, because if you try to read through the law, it's very, very hairy. And that's why we need to see the SBA guidance that was issued just last night. We may be seeing some technical correction bills, because this law was written in such pressure, and the lawmakers didn't really have time to read it. And the people who actually wrote the bill worked through the night to write it and kept their lamps burning. So it's the kind of thing that we may be seeing technical corrections. We may be seeing a little bit of change on the part of SBA, like we had seen after the CARES Act. But basically, according to the information available right now, all these changes, all these expansions, all these benefits certainly apply to second draw loans, PPP2 loans. If you have a first draw loan, then generally speaking, once you receive forgiveness, if you applied and were already forgiven, it's too late. Even if you only got partial forgiveness, you can't go back and ask for more. What if you've applied and haven't yet received forgiveness? Well, that Congress was silent about. Is there any way to amend your forgiveness application? We don't know. We have to see what SBA is going to say about that. However, if you haven't applied yet, then most of the changes still will apply to your first draw loan, at least the way it looks right now. And by the way, the one restriction that was not stated before was that if you weren't in business before February 15th, then you can qualify for a loan. I mean, if you going forward, you can't now get a new loan if you were not operating prior to February 15th, 2020. Interesting change there. Okay, but now let's look at the good news, change number 1 through 5. Newly eligible payroll expenses. I mentioned this briefly before. Any employer contributions for vision, dental, disability, group life insurance can now count toward forgivable payroll, and it's classified specifically as payroll. Up until now, it was only employer contributions for health insurance, employer contributions for retirement plans, or employer paid state and local taxes. Those were the only non-direct payment to employees that were included as payroll. That has now been expanded. So 2 important action items here. Again, you want to reach out to your payroll partner, make sure they're aware of this and make sure they can handle this for you and find out how to do it. You want to, many employers don't track this through payroll. It becomes an HR issue, how much they're contributing for plans. There's no reason that it has to go on the employee stub. This is an employer contribution. So you definitely want to begin tracking all of these group benefit payments through your payroll applications, through your payroll programs, software providers. And you want to do that going back You want to see if you can do that going back retroactively, because action item number 2, you may want to consider amending your original first draw loan application. And this is not for a second draw loan, but there is a way to amend. There will be a way. SBA will provide a mechanism for amending your original application and asking for more money in your first loan. That means even if you thought you were finished with your first loan, you used up all your funds, you're ready to apply for forgiveness, you may actually be able to go back, track costs that have already been paid, and get a loan which will become a grant and get assistance retroactively for amounts that you've already done out of pocket. That's a very big benefit and will need to be carefully reviewed with your tax planners and, of course, with your payroll service. Change number 2. There are newly eligible non-payroll costs, and we began to list them. Here we have a little bit more specific. Any operating expenses, that means fees that you pay to your payroll provider, cloud computing costs, any amounts for product delivery or service delivery, sales and billing costs, back office, accounting, inventory tracking, almost any operating expense can now be part of your PPP forgiveness. Again, only up to 40% of your forgiveness. It's non-payroll. But still, it can expand your forgiveness. Any property damage that you sustained, that your business sustained due to public disturbances in 2020 that weren't covered by insurance are now going to be forgivable. Any costs that you've paid to suppliers, whether it's supplies that are essential to operations or by a contract that predated your loan, or for perishables, it could even be a contract during the time of your covered period. Any expenses spent on worker protection, that would be PPE, or modifying your facilities to make them comply with any Health and Human Services or CDC or OSHA requirements due to the pandemic. And all of these, which is almost everything that, I mean, short of real estate and buying, but it's almost anything that a business could even dream of paying for, has become a forgiveness eligible expense. And again, you may want to go back and amend your original loan application and increase your first draw. Before you even think about second draw, you may want to go back and increase your first draw loan amount. And again, this factor to consider, if you've taken a first draw loan, you're not going to get the first bid at those funds for the second draw. There's certain amounts set aside for those who are only borrowing the second draw as their first loan. If you've already gotten a first loan, you're sort of second in line, but you still could go back on your first draw and expand the amount of your loan application. Now, keeping in mind, though, that all these non-payroll expenses still can't exceed 40% of your forgiveness amount. But this could be an incredible money-saving relief for businesses that almost all of their expenses, basically, they may be able to get as a loan and forgiven essentially as a grant. Tremendous subsidy, tremendous relief. That was change number 2. Change number 3 sounds technical, but it's actually a very big boon as well. And that is that your covered period, the time that you measure using your PPP funds, starts on your loan disbursement date. And up until now, it has been only 8 weeks or 24 weeks, depending on when you've gotten your loan and what you choose. The provision in the Congress in Division N of the Act states that you can now make it a variable. In other words, you, the employer, can choose any length of covered period, anytime between 8 weeks and 24 weeks. So if you think you've, used up all your funds and after 10 weeks, and you don't want to be blamed for any reductions in wages or in FTE that might happen after that, go ahead and end your covered period then, and at the end of 10 weeks. You can pick when. It can't be any later than September 30th, 2021, but you can pick. Now, the question is, does this apply to existing loans or only to new loans after the date of the law? It's not at all clear. Tax attorneys are still analyzing this, and we may not even have all the information we need about it. So this is something that hopefully the SBA guidance that was issued just now will clarify. But one action item that you want to do is make sure, those of you with Viventium, of course, you know you have the PPP suite with all the reports. But if you're not with Viventium, you might want to check with your payroll provider or your payroll software and see, are you able to do a mock-up? Are you able to test various scenarios? I want to see what it would look like if I end my covered period after 10 weeks, after 15 weeks, after 20 weeks, after a full 24 weeks. You can try different scenarios and just iterate back and forth until you find the scenario that gives you the highest forgiveness amount. Change number 4 in PPP is the simplification process. So up until now, it's been 50,000 and down was a simplified process. Congress has mandated SBA to come up with a simplified process for loans of 150,000 and down. It can only be a one-page form, Congress said. You cannot require employers to submit documentation. Apparently, that means there will be no penalty for wage or FTE reduction for those smaller loans. And not only that, but Congress has said that if it's between 150,000 and $2 million, you still don't need to submit documentation. You'll have to do certifications, check off boxes, but you won't need to go ahead and submit all those detailed payroll reports that originally you were obligated to do on the full form 3508. So we're expecting a full revision of all 3 SBA forms, the 3508, the 3508EZ, and the 3508S, as well as all the instructions. And therefore, at this point, the best action item is once again, just wait for the forms. And finally, the last PPP change is an extension of your payroll comparison date. So if you bear with me, we get a little technical here. There was a safe harbor that if you had reduced your employees' wages or you had reduced your head count, your FTE count, between February 15th and April 26th of 2020, and yet you managed to restore those wage levels or those FTE levels by some payroll comparison date that you would designate, then you wouldn't be penalized. Your forgiveness would not be reduced by the reductions. That payroll comparison date was only allowed to be up until December 31st. It has now been extended to September 30th, 2021. And again, you would want to work with your Viventium reports, or if you have something corresponding from your own payroll provider, to see if you can do mock-ups. I want to try, July 3rd, 2021. I want to try pick dates that you feel that you may have raised your payroll may be back up to what it was before February 15th, and see if you can come up with a date that will give you the highest forgiveness. So what comes next? First of all, the SBA guidance that was just issued, both for the old loans and the second draw loans, is going to require intensive review. The Viventium compliance team is working on that. And again, I just want to remind you all that we'll be holding another compliance webinar this coming Tuesday, January 12th from 2 to 3 p.m. And the registration links for that will be sent out. And that will focus in specifically on this new SBA guidance. Some of the open questions that we've posed today will hopefully have light shed on them. We're actually expecting all the safe harbor dates to change. These dates about when you have to look back and when you have to restore and what look back periods are. We're expecting that to be changed in accordance with the extensions. We are also expecting, as I mentioned, all new forms for forgiveness and instructions. IRS guidance is going to keep coming in. We're going to get a revised 7200 later in January, and the IRS again has advised employers to hold off on faxing in those forms until they do manage to revise the 7200. We're for sure going to see a new form 941 for the first quarter, because it's going to have to account for all those retroactive credits plus the continued FCRA credits, and perhaps even more, because President-elect Biden is basically calling all this legislation a down payment, stating that there's a lot more additional relief coming. We didn't even talk today about the stimulus checks, because that's not really a payroll issue, but of course that was one of the hottest topics in this legislation. And President-elect Biden is expected to pass more through with the assistance of Congress. I want to invite you to follow Viventium on our social channels and to visit our website often for additional analysis and update. As a matter of fact, those of you who, whether or not you're with Viventium right now, you'll be getting just a little brief survey at the end of the webinar when we finish in a few minutes just to gauge some information that could be helpful to you and see how Eventium could be of help to you. I want to encourage you now to type in your questions to your toolbar, and I'll try to address as we just have a minute or two, and I do want to respect everyone's time, but we've covered a lot of information today, so please feel free to put your questions there in the toolbar. I want to just read through and address some of the questions. Okay, I'm going to ask and answer a basic question. I'm not sure. Here's the question. I'm not sure if you addressed this. What is the difference between the employee retention credit and the FCRA? Okay, so that's a very good question, because I know everyone talks about credits and we bandy around these terms. What's exactly the difference? So FCRA said that if you have work for your employee, but your employee can't come to work, they're prevented from coming to work due to pandemic reasons, either they're sick or they're quarantined or they're caring for someone who's quarantined or they're caring for a child, then you must pay them. You're mandated to pay them up to a certain amount of paid leave off, and you'll get a credit for it. The employee retention credit is kind of like the flip side. You can't have your employee come into work. Either you don't have work for them in their particular job, or your whole business has been closed down. The employee would like to work, they're ready and willing, but they can't. And the kind of work they do can't be done teleworking from home. And yet, out of the goodness of your heart, there's no requirement to. There's no Department of Labor. With FCRA, there's a requirement to pay them paid time off. But out of the goodness of your heart, you keep them on payroll. You keep paying them. So then you can claim the employee retention credit for the amounts that you paid that you weren't obligated to because they weren't working. And in some cases, you can even claim the credit if you pay them for work, if you're a smaller employer. Okay, let's see another question or two, and with that, we'll probably conclude. Question: is the IRS releasing a new type of 941 for the employee retention credit of 2020? Or are they assuming that we will all file amended 941 returns? Okay, good. So let's clarify that to everyone, make sure everyone gets that straight. The Congress, not just the IRS, but Congress has told the IRS not to require amendments. They cannot force people to go back and amend second and the prior quarters in 2020. They must come up with some mechanism to avoid amendments. We're assuming that will be lines on the first quarter 941. But no, you will not be in an amendment situation, and you'll be in good company because most employers across the country will be doing these retro credits. They'll be retro, but not amended. Question: if we get the PPP, can we still get the employee retention credit? So the answer is yes, but you can't use wages that you're claiming retention credit for as payroll costs that you're going to ask forgiveness for. In other words, you can take both, but you can't get both for the same wages. Okay. Okay, we'll do one more question here. And we're a little bit over time, so just one more question. Can a company claim the PPP, and when that is up, claim the ERC credit for 2020? For example, take a PPP loan for May through October and the employee retention credit for November and December. The answer is yes, and even more than that. You can, if you had a PPP loan for May through October, you can still claim the employee retention credit for May through October, just not on the same wages. But certainly, if you had your PPP from May through October and those were wages paid and claimed for forgiveness, then certainly you can go ahead and claim the employee retention credit in November and December. And with that, I believe we are not just out of time, we are actually over time. But I do want to encourage you to visit us at viventium.com. You'll find a whole slew of resources on our COVID-19 solutions page, webinars, recordings, blogs. Please check our space frequently for updates as additional guidance emerges. And again, I want to thank all of you for your participation. This session has been recorded. You will be getting a copy of the slides and the recording, and I want to invite you to participate in the brief survey that you'll see at the end of this webinar. Thank you all very much and have a great afternoon.